You're listening to Hardscape Growth, a podcast for hungry professionals who want to grow their businesses and level up. Hello, everybody, and welcome to another episode of the Hardscape Growth Show. I'm your host, Alex from TechnoBlock, and in keeping with our theme of the Hardscape High Five, today we're talking about our numbers, and we're doing it with some pretty specialized people. We're talking with Joe and Carla from Cycle CPA. They handle accounting, bookkeeping, all that fun number services for contractors across America. So this is going to be a pretty interesting one. We're going to talk about cash flow. We're going to talk about the role of these types of professionals from an advisory perspective, kind of guiding you through how to navigate running your business and making sure that you have enough cash to run the whole operation and grow. What are some of the key metrics or performance indicators? What are some of the things we need to keep an eye on, and at what frequency to make sure we're navigating the right way? And, just generally, why do you need good accounting? Why do you need a good accountant? And what do you look for in finding the right type of services for your business? So why don't we get started right away? Welcome to the show, Carla and Joe.
Thank you.
Thank you, Alex.
So why don't we talk a little bit about how you guys came to found Cycle CPA, what you were seeing as a need in the contracting world, and how you feel you address that.
Yeah, well, I started off my career at a local CPA firm where, because of the demographic, there was a lot of contractors that, came into our place of business. We didn't really specialize in any area, but I kept hearing the same kind of pain points, like they need to know their numbers, the profit and loss, balance sheet. They had issues with estimating, job costing. And I tried to help them as best as I could in that capacity, but the problem is that we just pumped out tax returns there. Okay. So I couldn't really spend a lot of time with them. And then after that, I worked at one of the top CPA firms. But I always had it back in my head, like, I want to specialize in this industry because I saw the need was there. And so that's really how that came about.
Okay. And then, Joe, how did you end up getting involved in this whole thing? Well,
a big way that I got involved, or reason, is I am Carla's husband as well. So I do help to kind of keep the operations going with some of the other aspects of the business, while also continually doing research within the green industry and, trying to find ways to relay all of some of these, complex accounting, all of those different things over to, in a way that, you can really use in a business, and trying to, keep that as a priority for some of these business owners.
Let's try to build out a business that makes it easy for these other companies that want to work with you to deal with you and not have to get overly involved in the process and in the management and the bookkeeping and all that stuff. They can focus on the part they're good at, you focus on the part you're good at, and overall they have a solid business. Kind of the gist? Exactly.
And I think that's key to it as well, Alex, because it doesn't matter how much Carla and I know about accounting, right? What matters is how much do our clients or other business owners within the space, how much do they know about their financials so that they can use them to actually make important decisions within their company, instead of going solely on what their gut is telling them. Mm-hmm. Is it time to hire this employee? Can I step more out of the field right now? Can I buy this piece of equipment? Instead of making those decisions based on, what your friend down the street did, base it off of your actual numbers and, what your company is actually going through financially.
Cool. So I guess that kind of ties into the first point, which is, why do you need good accounting? I guess it's to give you that visibility so you're making an informed decision. What are some of maybe the less obvious reasons? Because I think the obvious ones are pretty darn obvious.
Yeah. So less obvious, I would say, outside of taxes, yeah. Right? Which I think is what a lot of people think of. And I think, trying to get people out of that mindset of thinking that you just need financials just for taxes, right? thinking instead of, okay, I'm going to be doing this estimate, and I'm going to be pricing this job. How can I use some of that accounting data to then turn around and estimate my future job more accurate, or based on my actual numbers, maybe my overhead percentage within the business. And there's a lot of great CRMs on the market, like Synced Up, or something like that, with where you can kind of enter all this data in, but there comes a point where there is no shortcut of getting some of this information. You have to do that bookkeeping, that non-exciting kind of work in order to kind of get to that point. So I would say, an accurate estimate, I would say ultimately starts with, knowing your specific numbers for your company. I'd say that's one of the bigger things to kind of look at.
Yeah, and I would say like a good way to look at it is your profit and loss report is company wide. You're looking, okay, at a period in time, all the revenues and expenses for your company, but all of those jobs that you're performing on a day-to-day basis, think of it as a little profit and loss report, and all of those add up to ultimately to your financial reports at the end of the period or at the end of the month, right? And so that's really what we do is we take the accounting knowledge that we have and provide that advisory level perspective, where we're meeting with business owners to try to bridge that gap. What are they doing out in the field versus, okay, what is your financial statements showing? And I think a lot of contractors don't know that an accountant could do that for them, could explain that process to them and kind of connect both sides of the business, operations and accounting.
Do you have like a good example or a good story that kind of illustrates that awakening of like, what, an accountant isn't just going to worry about the books and the taxes, but they could definitely help me out on an operational side too?
Yeah, no, definitely. So we were working with a business, and they came to us originally because they had an in-house bookkeeper doing the daily data entry, but they wanted more. They wanted to know why their business was really cash flow poor, operating at that level. It seemed like they were bringing in the revenue, but they weren't really generating as much cash in the business to reinvest. And they had been running losses for the past 5 years of business. So when I really spoke with them and got to know their key issues, I said, okay, well, you're having issues with cash flow. We need to implement a cash flow forecast. They were like, well, what does that mean? I don't even know what you're saying. How do we get started? So basically what we did is we forecasted the ending balance in their bank account for the next 12 months, right? And we utilized that as a tool to monitor and see each month. We would look at budgeted versus actuals to see where they were kind of falling short. And a big one was, of course, they had a lot of loan payments coming out. So I think they had like, $20,000 worth of loan payments or something like that coming out of the bank account. And then another item was their labor costs was high. Huge, not a huge surprise there, right? Labor costs are high. So one of the things is what we did is we found out that they were estimating, the business owner thought that they were estimating at, and I'm just going to throw like a random number out there, but let's say they thought that they were estimating at $90 an hour, but when we calculated it, they were estimating at $50 an hour. And we really got down to the core reason why, their estimates were off. And then after a while, we saw the returns on, okay, their labor had started to minimize based upon a percentage of revenue. So we got that figured out. We were monitoring the budget direct labor hours that they were spending out in the field versus the actuals each month. And we really got to hone in on that. And of course, hand in hand, the cash flow did start increasing in the business, but it did take some time, and starting to prioritize paying off those loans, having a better accounts receivable management, because although they had this in-house bookkeeper, they didn't know how to manage that bookkeeper. Were they collecting fast enough? They really weren't collecting fast enough. So we came up with some procedures on that. That also helped with cash flow. And, it makes me happy to say that, after 5 years, we were able to turn a profit within, the year that they were on board with us. So I guess, really working through those kinds of reports and advising them along the way is really what helped.
I think it's there's a lot of good examples in there, but even just the process for receivables, the last example that you gave, I find that interesting because what is the typical process for receivables that you're encountering right now when you get started with someone?
Yeah, they're like, well, what is an accounts receivable report? How do I pull that? It goes from that, or they're reviewing it monthly. When we're telling people we have to review the accounts receivable report weekly. There's an accounts receivable days that you can calculate. Now we calculate that the average collection days, you should be around 30 days, right? And sometimes we see clients like 45, 50 days out. And, it's not good enough, right? We want to collect within 30 days. So a process is something like we review it weekly. And then once we review it, we reach out to the clients X amount of times. And then after they don't get back to us after 3 times, then we cut service or we charge a late fee. That would be a full process in place. But when I speak to a lot of contractors, they don't really have any specific details on when that happens, what triggers what, how many times they reach out to the client, stuff like that. I think a lot of the times when I speak with them, they say, well, I just send invoice reminders out. They'll pay. And it's really not, I think it's the worst way to go about it. I think if they don't pay once to an invoice reminder, it doesn't matter how many times you send it out, they're probably not going to pay. And that it may not be because they don't want to pay. I just think that you need that extra process of reaching out, texting, emailing, whatever that is.
So defining that process. And I like also the increased frequency of the reviews too, because if you're only reviewing monthly, you'll never be able to keep it under 30 days because you're only looking at it once every 30 days.
Yeah. Yeah. I was actually talking to someone yesterday, Alex, and we were looking at their accounts receivable aging summary. Okay. Right. So for some of the people that don't know what that is, it basically shows, how far out are your customers late on the payment. And there were a bunch that were past the 90-day mark, and he knew about it, but after the call, he knew that it was a priority, right? Mm-hmm. That there was $20,000 that were sitting in that account, and kind of building that process in, and making it a priority is, these are things that really impact cash flow a lot, and definitely something to really, really consider.
This episode is brought to you by hardscaper.com. The Hardscaper mission is to empower industry professionals with the skills, inspiration, and confidence they need to take their businesses to new heights. Struggling with training programs for your team? Looking for helpful tips to build a better company? Subscribe today to gain access to hours of interactive on-demand hardscape construction and business courses for free. Check out hardscaper.com. So let's say I'm a smaller business owner and I'm hearing what you're saying, but it doesn't seem to be that much of a problem for me right now, or at least my perception is this isn't that big of a deal. I complete the build, I collect that last check. Sometimes I have to come back for a couple little things and they're holding back a little amount. What's the real importance of the receivables ties into the cash flow. So the cash flow forecast is something I kind of want to explore a little bit more. Like, what is the real definition of a cash flow forecast, and why is it so important in a business that, you know, may not have a ton of overhead, may not have a ton of recurring costs? Like, if it's me and 2 or 3 employees, do I really need to worry about that?
Yeah. So I'm going to throw out a scary statistic out there. So 80% of businesses fail due to cash flow issues. So whatever you can do on your end as a small business owner to try to prevent or plan, you know, around your cash and be very organized and strategic in that way, you should do, right? You need to be prepared. And a cash flow forecast is a tool that's going to help you monitor your cash inflows, which means money that's coming into the account. So it could be revenues. That's your first source of cash inflows. It could be working capital loans. Maybe you got a loan from the bank that they're going to provide for you so you can run your business. And then, of course, the cash outflows, all the expenses that are coming out, the daily expenses and any loan payments, things like that. Basically, it's going to project the next 6 to 12 months of those inflows and outflows, and it's going to leave you with the ending balance or projecting ending balance in all of your business bank accounts, you know, checking, savings. So you're going to use that as a tool because a lot of businesses are seasonal in this industry,
Absolutely.
right? And you need to, and if you're not planning for that, when what I see the most is, well, the money's good right now, right? During the summer and the spring months, you're getting all that money in, but you're not thinking about the lower times in the winter. And it helps you plan ahead of time. Okay, how much cash reserves do I need to survive that winter season? Or if I lose this big client that I have, you know, what do I need to have or plan for in my cash reserves to keep my employees around and keep working until I make up that revenue? Because business is unpredictable, right? But at least if you have that tool, you can at least plan for it a little bit. And what we see is, for example, if your business is doing great with cash flow, you can use it for scenario planning. And what I mean for that is, let's say that you're planning to get an office administrator working. Mm-hmm. Then you have to take their salary. You can plug that into your forecast and see if you can afford that. And if you can't, what do you need to adjust to be able to afford that, right? How much revenue did you need to bring in to be able to afford that salary? Or let's say you're going to purchase a truck. Can I make those loan payments? For example, the other day I was on a call. The business owner said, well, I want to purchase a skid steer. And we saw that the best month for him to purchase that was in May. And they were going to purchase it in March. So now they're going to wait till May, because May they're going to have a large inflow of money and they're going to be able to put the more money down. So if you have a month-to-month cash flow, these are the things that it helps you make those decisions. Timing-wise, it's huge. It's huge.
Yeah.
So,
and you know, the larger a company gets, the more valuable this kind of reporting is going to be to that company. For the same reason why larger companies have a CFO, one of their main goals is to help manage risk in a company. And cash flow is a huge part of that. So the other interesting thing about the cash flow forecast is, as I mentioned briefly earlier, is, you know, a lot of contractors, I think, have an idea of, okay, what are the expenses for the project? Even, you know, what are some of the overhead expenses? What are the revenues? But what are all of those other cash outflows that don't show up in your traditional profit and loss statement? You know, like Carla mentioned, like your loan payments, asset purchases, different things like that, which in this industry, you know, it can make an an enormous difference. And as companies from what we've seen, especially as companies get into that 7-figure mark, typically in revenue, it starts to make more and more sense to really stay on top of, this sort of cash flow forecast, for sure.
It's honestly great answers and great examples too. They hit home with a lot of stories that I can think of myself. I guess that advisory perspective is something that helps address all these things, right? Like you're helping them build out that cash flow forecast. You're looking at it and you're able to do, like you just said, like, I know you want to buy that skid steer, but the biggest cash influx you have is May, not March. So if we can do that, you put more down, our monthly payments are lower. It's less risk, going into the lean months again, because now you don't have a, $2,200 payment to make December 31st. You have a $1,400 payment, and we can do that, and you're not compromising anything, right? That's the gist of it.
Exactly.
Absolutely.
Yep.
What about, we talked about the cash flow forecast. We talked about looking at receivables on a greater frequency. What are some of the other metrics or KPIs, or call them what you want, that a good business owner would be looking at, and at what frequency, to make sure that the ship is not heading for the rocks?
Yeah, so I'll start with the profit and loss, and then Carl will get into the balance sheet items. But in regard to your profit and loss statement, you're going to want to be looking at that on a monthly basis typically, and really starting with what is your revenue trend. And you could basically view this based on, you can be comparing this to previous periods. So for instance, right now, what we're doing is we're comparing, let's say, the first 3 months of the year in 2023 versus, okay, what did those months look like last year during those same times? And the reason that you do that kind of comparison is because for a lot of areas throughout the country, the seasonality aspect of it. It wouldn't necessarily make sense to compare this period to maybe a period, in the winter, because it's different things are happening, right? So, looking at that, and then also comparing it based on, what your revenue is, right? And using your profit and loss and going line item by line item, and using your revenue figure as the base, right? As almost like the 100%, right? So looking at, okay, out of that 100%, which is your revenue, let's say it's 100,000 for the month, maybe 25,000 went right to paying the employees in the field, right? And maybe a certain amount, 20% went right to materials, So looking at some of those larger direct expenses, right, also known within the industry as maybe cost of goods or cost of sales, those are the expenses that are directly related to you producing the work in the field. So looking at some of those larger expenses, and then all of those direct expenses, basically what is left is your gross margins, right? And then so that's another KPI that you're going to want to be looking at. So that'll give you a good indicator of how efficiently you're operating in the field. But of course, that's not what it's. Unfortunately, you're not keeping the gross margins, right? Right. You're keeping the net profit, and what's in between, it's your overhead expenses, right? So things like your office expenses, accounting, legal fees, software, stuff like that, and really looking at each line item as a percent to your total revenue, and then also looking at it, you can even compare it to industry averages. So maybe industry averages, let's say 25% should be your overhead, right? So kind of looking at that number month to month as well. So, I would say just to kind of sum it up, Alex, really looking at, prioritizing, you want to be focusing on, first and foremost, the items that have the largest effect on your company. So you can be looking at your insurance expense and some of these small expenses and saying, oh man, I can really lower that, or, why is that so high? when maybe if you made just a little tweak within your training process in the field or the processes you were doing in the field, that's going to have a much larger impact on the company. So looking at some of those larger expenses like your labor, materials, different things like that, looking at your gross margin, looking at your overhead percent to revenue, net profit, I would say those are some of the biggest, in regard to your profit and loss.
I want to clarify one thing that you just said. Are you basically saying that if you want to discipline the expenses or you want to ensure that you have a better financial scenario for your business, you're better off to dedicate your energy and time to the things that will move the needle the most first? And that's because if you spend your time and energy on all the little things like lowering your insurance rate by 5%, the time that you're going to spend on getting other quotes and consulting and bing, bang, bang, okay, you saved 5%, but ultimately at the end of the year, that's going to save you maybe $1,000. Whereas if you really took a good hard look at your training process and you realize okay, I'm underestimating our excavation time by 2 hours on every project. And that, times 3 people times my machine time is costing me $2,000 a week. Like that is going to save you a lot more money. That's going to move the needle a lot more than the insurance, but it's one of those things that's a lot harder work, right? And
exactly.
that's where looking at the data and working with people like you make it a little bit easier. Is that right?
Exactly. Yeah. And even, as a company grows, Alex, sometimes it may make sense for them to have a little bit higher overhead just because, you may have to hire that person in the office before maybe you have all of the revenue to support it, but you have to make that move in order to continue to grow. Growth isn't a perfect, line.
It's not a straight line, no.
Yeah, so
it'd be nice, but that's not how it works. Okay, so that was the profit and loss, and then you said Carla was going to get into some of the other things. So what are some of those other things?
Yeah, so one of the questions I get often is, can I purchase that truck or can I purchase that skid steer? Like I said before, can I do that? And so the other day, a business owner asked me if he was able to purchase a car for their new salesman that they're bringing onto the team, right? And so there are, I would say, some other metrics that you can look at, but one of the first ones that I gravitate to right away is return on assets. So what that is calculating is how well you're utilizing the machinery, equipment, trucks that you already have in place in the business to create a profit in the business. Okay. Are you utilizing that effectively and efficiently right now, what you have in place? And so the formula is net profit divided by total assets. So now, for that metric, it's important in the industry because, of course, we have those big investments that we need to make. It's an equipment heavy industry. You want to get a big return on those investments, which is a good return would be around 25%. So this company in particular that I'm referring to, they were getting a little bit more than 25% on the trucks that they already had in place. So I said, and I mean, as long as that's good, cash flow's good, you're able to afford the loan, right? Payment, the down payment and the monthly payments and, some other factors. I did advise the company that it would be a good decision to make. Again, basing it off of the balance sheet and their financial statements, not of, I think it's fine to do, or looking at your bank account balance or anything like that. So
basically, when you say net profit divided by total assets, I mean, the formula is simple, but my total assets include my fleet of vehicles, include my fleet of equipment, include my property, buildings, any things that I have it's all of those things, profit divided by the value of those things, the current today value, the purchase value, the future value? How do I calculate that?
That's a good question. So I should say total fixed assets. So
Okay.
your fixed assets, everything that you did describe would fall into fixed assets. And on your balance sheet, it's recorded as what we call as accountants, historical purchase price. So what that means is we recorded it. Let's say that today you went to go purchase a mower for $5,000. That's what is going to be on your balance sheet is $5,000. Okay. Minus depreciation, that means it's accounting for the wear and tear of the mower. Each year, you're going to lower the value of the mower a little bit. Let's say you're going to hold that mower for 5 years. Each year, you're going to lower that by $1,000. So that is like a subtraction on your fixed asset number.
So if I don't do anything to my fixed assets, I have not upgraded my equipment. I have not, like, today it's worth the most it will ever be if I look forward into the future. Every day it's worth less and less and less. So,
right.
Well, that would increase the ratio though, right?
It would increase the ratio because that means you're doing more.
I'm getting more with something that cost me less.
And sometimes that's not good because we go that way too. And we see it so low and we're like, well, you have a lot of tired out junk. Maybe you need to upgrade a little bit.
That's where I was going. Like, well, I've been driving this truck for 20 years. It's fine.
Yeah. We
you know,
too. Yeah.
And it's also something, maybe a company that's listening is looking to acquire companies, looking at ratios like this, and people know, like, for instance, looking at, if they purchase a house, the average person may know, okay, what is the equity that I have in my house? But what is the return on equity you have in your business? And similar to the return on assets, basically, the net income, over the equity in the business. And one of the nice things about ratios like that is that it involves net income, right? And it's good to as a business owner, hold yourself accountable to your net income, because sometimes it could be nice growing your company, top line revenue, but at the end of the day, when you look at some of these ratios, it's going to hold you accountable to, being able to produce in the field and be efficient, and make that net income for sure.
Do you have any other good ones? I like that. I wrote that one down as the "can I purchase that blank" question. That's how you answer it.
I think a return on equity, one that Joe just hit on, which is for any business owner, not just this industry, is equity is your stake in the company as a shareholder, what you own, right? So we're talking about return on equity, or you can talk about return on investment, right? In the business. So you put a lot of sweat equity, put a lot of maybe your own money into the business. You want to make sure that the business is creating a return for you. So that's net profit divided by equity. And what we see, what we want to see is at least a 50% return, right? Now, if you're someone who's just starting off in the first few years of business, you may be even in the negative, right? Negative return on the business because you're just starting out. That's normal. But like after the 3-4 year mark, we want to turn that into a positive number, eventually getting you to a 50% return for some steady years after that. Yeah.
So how do I calculate that? How do I calculate the equity part? Let's say I'm the sole proprietor, I'm an owner operator, and we take that same example. I have 2-3 employees. How do I calculate what my equity is to be able to determine, like, okay, am I hitting at least that 50% now?
Yeah, that's a good question. Your equity is going to be found in your balance sheet. So if you have an accounting system, it's in there. But the calculation of equity is the accumulation of your profits or losses for the years that you've been open, right? Mm-hmm. So it's a cumulative number. So what increases equity is if you make profits over the years. What decreases equity is if you make losses. Another way to decrease equity is if you're taking owner's draws or you're putting personal expenses through the business. We see that a lot too, commingling personal and business. That's going to deplete your equity because you're taking money out. And some other things to increase equities, if you contributed property or cash to the business, then that increases your equity.
So if I invest my cash, or if I had a piece of property, let's say I own, 5 acres, and I convert 3 of those acres into the business property, let's say the zoning permits, whatever, that would equate to increasing my equity in the business.
Right.
Yeah.
Yes.
Cool. If I had to ask you, like, what's the biggest mistake or pitfall that you see that anybody listening right now, like, best free advice you can give, I guess, would be the question.
One of the biggest pain points that I see is your overhead expenses are high for the industry. It's like, it's always a problem with not always, a lot of our clients have that issue. And I think it's because as contractors, they're good at, they have good creativity. They're good with working with their hands. That's why they started the business, right? Being out in the field and mastering their craft. But it's not because they wanted to sit behind an office. And what we see is the overhead expenses, overhead salaries are really high because that business owner is not prioritizing streamlining the overhead tasks, the administrative tasks, such as sales, marketing, advertising, HR, operations. They've streamlined out in the field, their field labor operations, and to streamline how to run that, but not really the administrative side. And that's really the biggest thing that we've seen. So I guess my biggest piece of advice is monitor overhead costs closely as a percentage of revenue. Like Joe said, you want to be between 25 to 30%, especially your overhead salaries, and implement technology first before you hire someone on to take that role on. So if you're getting overwhelmed by phone calls, right, or something like that, think about, okay, what kind of service or what kind of software can I implement to kind of streamline these phone calls, right? Maybe think about fractional staff first. You don't need a full-blown office employee working full-time hours yet. Stuff like that, getting creative with the overhead. And then another big thing is just not having accurate financials for so many years. Like I call ourselves, like, we're cleanup experts, and sometimes we're forensic accountants, and sometimes we're teachers at the same time. And it's because any business, small, even the largest business, you think that they have it together. They don't. They don't. And it's like, when we go in there and we see the books and they haven't been done for the past 5 years or 3 years, and we need to get them caught up. And it's like, how are you operating the business without looking at a financial statement for so long? And, and we have so many people in that position, and we're happy to take you on and get you into the right direction. And so many people are like, okay, this is such a sense of relief, and they're able to get accurate numbers and, not fly by the seat of their pants kind of thing. So,
yeah. And I think it's important to not underestimate the impact. And this might sound like a commercial for you guys, but it's the truth. Like, if it's not something that you are willing to dedicate the appropriate amount of time and energy to, because you prefer to work on other things or you're better at other things, that's perfectly fine. Farm it out. Hire someone to do it, someone who's competent, who's qualified, who's specialized in it. And it's an investment in your peace of mind. Your numbers will be right. You'll be more accurate. You'll be more profitable. You'll make wiser decisions. And for what? For whatever the fees are. those fees are easy to calculate. You know what they are. Plus the accountant is going to help you figure out how to pay for those fees. So like if there's one service that's going to make sure that they get paid, it's the accountants. So like it's win-win across the board. But I think to neglect it or to think that it's not that bad, if everything we just talked about feels somewhat foreign, it might be bad. It might be worse than you think. And I'm not trying to scare anybody. I'm just trying to give them a heads up, because now is when the cash is coming in. Now is the good time. And like you guys were saying, the closer we get to the end of the year, the more it leans out, the more we got to be careful. And we're already in a position where the phones aren't ringing as much as they were the last 3 years.
Yeah.
The projects aren't necessarily as big, or they're being phased out, which means you're not getting as much cash per contract sold early. It's being stretched out. So that cash flow management becomes increasingly important. So like, I find everything that we've covered extremely relevant. And I think it's important that people pay attention to it, and maybe even listen to this a couple of times, or go back to a couple of those key moments when we're talking about, the profit and loss statements and the cash flow forecast. I think that one is a really big one. I think, you don't want to have to get to a point in the year where you're just dumping everything on the credit card because you're waiting for payments to come in, because you're only looking at receivables once a month. Like it's all a big system, and that's what you guys do. You help them build the system, implement the system, and then you can operate that system over time, or you can just set them up and send them on their way, right?
Absolutely.
Okay. Anything else you want to add, guys, before we wrap up for this week?
Yeah, so just to kind of go off of, your point, Alex, with where, because the economy is the way it is now. And, I'd say knowing your numbers, doing your accounting accurately and timely, and getting that information monthly will allow you to be confident about your pricing, and if you are finding that you're seeing less potential customers out there, instead of trying to make it work and maybe discounting your work a little bit or something like that, maybe try, increasing your marketing spend a little bit, or make other adjustments, because that's something that we're seeing. And I don't want people falling into that trap where you're just trying to do more work. You're trying to increase volume and stuff like that. Focus more on, being patient, working with the right customers, and then you're going to make a profit. But, I'd say just kind of based on, where we're at now, this time of year, and just kind of what we're seeing, I think, I think it's an important thing to remember.
Right. Yeah. The answer is not always just work harder.
Yeah.
Sometimes you got to take a step back and work smarter.
Yeah.
Okay. What's the best way for our listeners to find you guys? If they want to consult or reach out or hire you straight up?
Yeah, we have a Facebook group called Landscaping Accountant, so they can you can hop on there. We have a community there. Also, you can just visit our website, cyclecpa.com. We have webinars and some other educational videos in our YouTube channel, Cycle CPA. So, any of those would be a good way to either look at some of that content or reach out to us as well.
Okay, and we'll put those links in the show description. So those of you listening, just go to the show, hit more, and you'll see those links on there, so you can reach out and connect with Joe and Carla, and get your numbers in check, and make sure that your business is as profitable, if not more profitable, than you thought it would be when you got started. Guys, I want to thank you so much for joining us on the show here today. This was super informative. I have a ton of great info written down, and I think we did a turn of a lot of very key elements to pay attention to. So thanks a lot for joining us, and until next time, everyone, work hard, pave harder, and we'll see you next week. You've been listening to Hardscape Growth, a podcast for hungry professionals who want to grow their businesses and level up. Each episode is all about taking the next step in running your business, so make sure you never miss a show by subscribing on your favorite podcast player. And if you're finding this information to be useful, help others in your position discover us by giving us a star rating and leaving a comment. We'll see you next week.